Why do certain hedge funds remain profitable even while the rest of the world is on fire? In 2008, while most portfolios were being liquidated, Bridgewater Associates' Pure Alpha Fund recorded positive returns. Fast forward to 2025, it delivered 33%, nearly doubling the S&P 500's performance. Make no mistake, because this isn't just luck, but the result behind a 500-year historical framework developed by Ray Dalio. Today, we're breaking down the 3 pillars of his methodology: the debt cycles, the 4 economic seasons, and the big cycle of world order. To understand how gold has shifted from a tactical hedge to a structural necessity, especially now in 2026. My name is Phoebe, and you're watching TradingKey. Understanding the debt cycle. Dalio's macro starting point is simple. Economies are driven by debt cycles, not emotions. To find the alpha, we must distinguish between the short-term debt cycle of 5 to 8 years and the long-term debt cycle spanning 50 to 75 years. Right now, we are operating at the terminal stage of a long-term cycle. Historically, as cited by Bridgewater and Deloitte Research, when total debt to GDP ratios sustain levels between 200 and 300%, the system becomes hyper-fragile. But the second derivative is what matters. Let's look at the interest to revenue ratio. In fiscal year 2025, U.S. net interest payments hit approximately $970 billion, consuming 19% of federal revenue. According to CBO baseline projections, this will exceed 25% by 2036. When interest costs outpace revenue growth, a sovereign has 2 exits: default or devaluation. History shows sovereigns almost always choose the latter. This brings us to real interest rates, the nominal rate minus inflation. Gold has a rigid inverse correlation with real rates. When real yields on 1-0-year tips trend toward 0 or turn negative, the opportunity cost of holding gold vanishes. Capital migrates from government promises to physical certainty. What are the 4 economic seasons? Knowing your location in the cycle is the first step. Knowing where the capital flows is the second. Dalio's 4 economic seasons framework categorizes the world by 2 variables: growth and inflation. Every asset has a favorable season. Stocks thrive in spring, defined by rising growth and falling inflation. Commodities dominate summer, where both growth and inflation are rising. Right now, we are oscillating between autumn stagflation and winter deflationary pressure. In these quadrants, traditional 6040 portfolios fail because stocks and nominal bonds suffer simultaneous drawdowns, exactly as we saw in the structural shifts of 2022 and early 2026. Dalio's solution is the all-weather portfolio, built on risk parity. While a traditional portfolio puts 60% of capital in stocks, those stocks account for 90% of the risk. The all-weather approach balances risk contribution equally across the seasons. In this framework, gold is the structural component designed to carry the portfolio through autumn, a period defined by monetary stress and institutional distrust. The mechanics of the big cycle. The big cycle of world order is Dalio's flagship framework for predicting currency and asset valuation. It is a 1-0 stage template of how empires rise and fall, driven by the interaction of debt, internal stability, and geopolitics. First, we have the rise, or the efficiency phase. A new power emerges with low debt, high productivity, and high institutional trust. Its currency becomes a medium of exchange because it is backed by actual output and sound fiscal management. Next is the top, or the overextension phase. The nation wins the ultimate prize, the global reserve currency. This allows it to borrow massive amounts from the rest of the world. But this success sows the seeds of decline. The military becomes a cost of empire, the wealth gap widens, and high standards of living make the nation's labor less competitive than emerging challengers. Finally, we hit the decline, or the devaluation phase. This is where the big cycle meets the long-term debt cycle. To fund its overextended lifestyle, the nation enters a debt trap, printing money to service old obligations. This triggers internal disorder and invites external challenges from rising powers. In the decline phase, financial assets like bonds become toxic because you are being repaid in depreciated currency. The thing is, gold has no counterparty risk. It is not someone else's liability. In the final stages of the big cycle, gold acts as the structural reset button for the global monetary system. What can we learn from Ray Dalio? We're witnessing a great migration from financial wealth to real wealth. According to data from the 2026 Davos Forum, gold has effectively surpassed the euro as the world's second largest reserve asset. This is a collective realization that the capex treadmill of sovereign debt is reaching its limit. In the value chain, the winners are the suppliers of certainty. Central banks are swapping single sovereign debt for neutral assets, making gold a rigid link in the global monetary chain. We also see victory for the value chain of scarcity. In an environment where M2 money supply must accelerate to fund interest payments, assets with a fixed supply velocity win. Dalio's methodology suggests a strategic gold allocation of 5 to 10% in normal times. However, in this high debt environment of 2026, he has advocated for raising that to 15%. This is a structural hedge against the five forces overlap: debt, political polarization, geopolitical conflict, technology shifts, and natural stressors. So, are you positioned for a permanent spring, or is your portfolio built to survive the cycle? Let me know your logic in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey. Give this video a like and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.